Hello and welcome to the Business Standard Morning Show. I'm Ishan Ghera and here are the stories for the day. While the world went gung ho about the rise of cryptocurrencies last year, the yellow metal, which has not lost its shine as an investment option for thousands of years now, yet again proved its mettle. As the pandemic waned and lockdown lifted, the wedding halls came alive to the sound of DJs and to the shine of gold jewelries donned by the bride and female guests. India imported 1,050 tons of gold worth about $55.7 billion in 2021, more than double the amount in 2020. Last year's gold import bill surpassed the previous high recorded in 2011. So, what is behind Indians' renewed rush for gold? Our next report finds out.
Indians will build on their love for gold this year as pent-up demand heralds a period of robust sales. This was the main finding in the World Gold Council's recent report, The Drivers of Indian Gold Demand. The report stated that imports remain strong and retail demand was expected to pick up when pandemic restrictions were lifted across the country. Data from the previous year illustrates this point. India spent a record $55.7 billion on gold imports in 2021, buying more than double the previous year's tonnage. The 2021 gold import bill also surpassed the previous high of $53.9 billion in 2011. Gold's price drop favored retail buyers and there was strong pent-up demand for weddings in October last year. Rising incomes are one of the biggest single drivers of long-term gold demand. This suggests that as India's economy grows, demand for gold should increase, the report stated. However, a fall in employment numbers, particularly salaried employment, and a poor consumer sentiment index could seriously affect the sale of the yellow metal in India. This is at a time when the Omicron variant of COVID infection is rising across the country. Nevertheless, India's strong gold consumption in 2021 and the expectation that its price may recover to 55,000 rupees per 10 grams from near 49,665 rupees now amid pandemic woes, inflation worries, and a stronger US dollar could definitely cause a strong uptake in the demand for gold this year in India. Recent data also suggests that since the pandemic-induced slowdown, the demand for gold is on the rise in India. In 2020, gold demand stood at 450 tons. But in the first 9 months of 2021, India's gold consumption stood at 360 tons, driven mostly by demand for jewelry. The end-year forecast for gold consumption in 2021 was 600 tons, according to the World Gold Council. It is worth noting that several Indian households view gold as an important investment, treating it as a hedge against inflation. It's an investment that cuts across the entire socioeconomic spectrum and is commonly used as a bride's dowry in Indian marriages. So, the pandemic and all its related uncertainties could actually accentuate the demand for gold in India. A lot more will be known in the wedding season that starts January 15 across India. We spoke to Sudhish Nambiat, head of India Gold Policy Center at IIM Ahmedabad, to understand what the demand for the yellow metal will be like in 2022.
So, if you have to look at 2021, one of the main drivers, there's been a good study actually done on that front, wherein you see historically, whenever Indian equity markets have performed really well, and the same years, the Indian gold demand has been exceptionally good. And we have seen what's been the kind of performance for the equity markets in 2021. A reason why we had a solid imports that's happened, the record imports that happened last year. And there's something that could continue into 22 as well. So 22, what it means is the sentiment. It's basically a sentiment that drives the market. So sentiment that's driven from the urban investors and also how the agri demand plays out because of that. So both were kind of positive for last year, for 2021 calendar year, I mean to say. And 22 again, the forecast as such remains really positive for the equities. They're really bullish on the at least on the Indian equities front. And we expect the same to continue, but we might not have another record here, but demand should be demand should be around 600 to 700 tons for the domestic market. That's something that should be holding on to.
And what will be the trends in gold that the industry and retail investors should keep an eye on?
Just before we started this conversation, a circular was released whereby jewelers are being allowed to import directly through the International Bullion Exchange. So this is one of the massive development that's happened since 1997 for the Indian gold market, where the jewelers are given a direct access to the to importing, just cutting off the intermediaries in between, like banks or any of the nominate agencies. So they have two ways to access the market. One, they can go through the banks for the nominate agencies and the DFT appointed nominate agencies and nominate banks. Otherwise, directly access to the exchange. So that's one big development. So how that plays out is something that we need to watch for. Looking for further clarification through circulars from the International Bullion Exchange and the IFSCA. So the second part is for the retail investors. So for the retail investors, is there going to be a cut in the duty? This is something much debated over the last 3 months at least, for the reason that we had some really big unofficial numbers, and cutting the duty is also very much within the framework of what I'll say, getting the trade through official route. So and making it more, getting it more in the formal channel. So if that happens, if there's a cut in the duty, there'll be a lot of enthusiasm within the retail investors to buy, even if it drops by 3%. There'll be a lot more incentive for them to get to the market and buy.
Whenever Indian equity markets do well, the demand for gold picks up as well. We should expect a year of robust growth in demand. However, it might not turn out to be a record year. A lot will depend on the severity of the Omicron variant and whether we again witness the cycle of lockdowns and curfews.
It was indeed the wedding rush which pushed India's gold import bill to another high last year. But the spread of a new COVID-19 variant is threatening to spoil the wedding industry's party again, at a time when it looked all set to recover its previous losses. Restrictions are back again. Delhi has capped the number of guests in any ceremony to just 20. Several other states have taken similar measures. Our next report tells us more about how Omicron may deal another blow to the wedding industry.
Another round of restrictions is forcing people to postpone weddings. Some are going ahead with a pruned list of guests, but even the close relatives add up to 100 or more. As Delhi capped the number of attendees to just 20, people are in a dilemma whom to invite and whom not to. And the wedding industry is again in a quandary. When India's first lockdown was announced nearly 2 years ago, couples across the country postponed their wedding plans in the hope that the pandemic would soon go away. But when it became evident that COVID-19 was here to stay, Zoom weddings and intimate ceremonies with just family members and close friends became the trend. This obviously was not a good news for the vibrant marriage industry in India. It suffered huge losses. And there was no word on lakhs of workers employed in the unorganized sector in small cities and towns. More than a year later, and after bracing 2 coronavirus waves, the sector was finally finding its feet. Big fat Indian weddings were back towards the end of last year, with families splurging the money saved up during the pandemic. Our Instagram feeds were filled with pictures of friends either getting married or attending a marriage. The wedding business was returning to normalcy. Such was the rush that venues were booked months ahead and hotels were charging a premium for some auspicious dates. But it all seems to have come to a standstill again with the onset of Omicron. States including Maharashtra, West Bengal and Tamil Nadu have limited the number of guests that can attend a wedding, Rajasthan, a popular destination for extravagant marriages, has capped the number of wedding guests at 100. The government in Delhi, one of India's biggest wedding markets, has curtailed the number of guests at a wedding to a mere 20. It also went one step further and ordered weddings to be held only in a court or at home, dealing a huge blow to hotels and banquet halls. We spoke with Ashish Bubna, Director of FNP Weddings and Events, which plans events across India, to understand how the new restrictions have impacted their business.
When we take about Delhi NCR, most of the functions have got cancelled. And yes, due to the restrictions, people are postponing their functions. So we are seeing the cancellations and we are seeing very, very much decrease in the demand of the weddings which were supposed to happen. So it's quite evident, the impact is quite evident. It is very much visible. The guests are turning down the invitations that due to this COVID thing. People are not very much keen also. So it's both ways. November, December was good. Like we did good numbers as in terms of functions. It's not gone to pre-COVID levels. I would say it's in January, it's quite around 60-70% of a loss to us because of the cancellation.
An estimated 10 million weddings take place in India every year, and the Indian wedding market is estimated to be worth $80 billion per year, and it is growing rapidly. Murugavel Janakiraman, the founder and CEO of Matrimony.com, told Business Standard in a recent interview that he expects the wedding industry to touch $500 billion in 10 years. The marriage sector has a multiplier effect on the economy. In addition to event management firms and hotels, weddings involve the services of more than 24 sectors like catering, flowers, jewelry, clothing, photography, transport and entertainment, to name a few. A large number of temporary jobs are also created during the wedding seasons, which is going to be affected now. Business worth roughly Rs 4 lakh crore was expected to be generated in the upcoming wedding season that begins from the third week of January and lasts up to March. The Confederation of All India Traders has said the wedding trade is now likely to be reduced to just Rs 1.5 lakh crore. In the first phase of the wedding season in November and December last year, traders registered seasonal turnover of about Rs 3 lakh crore, according to Kate. Parthiv Tyagarajan, the co-founder and CEO of wedding media company WeddingSutra.com, gave us his observations about the industry.
17th November to 17th December was the golden month for the wedding industry because a lot of the weddings which got postponed, they happened then. Well, a lot has changed, and fortunately, the wedding professionals are all learning to work with a plan B. All planners are realizing that it is not going to be easy for quite some time. It may not make sense to postpone. And if you decide to postpone, you quickly get married when the timing is good. And for that, you cannot again have a very long planning period because there's no way anyone can say what it's going to be like. One cannot be confident that in November 2022, you can have a 500 or 1,000 pax wedding. That a lot of the HNIs prefer to host weddings in January, February, where the venues are amazing thanks to the weather. But like all industries, wedding industry has to adapt. There is no other way out. It may not be easy to have those big fat weddings again, but what is wrong in running a business which is about slim and smart weddings? It doesn't have to be about the big fat weddings alone. There always has to be a balance between business and safety.
Jewelry sales may also cool down if there is a decline in the number of weddings. Gold demand was robust last year as pent-up demand emerged for weddings that were delayed when the pandemic first hit. Delhi's wedding industry is hoping for the government to revisit its decision before the wedding season resumes again from the third week of January. But the government is also in a bind as the new COVID-19 variant is spreading very fast.
Unlike the wedding industry, the equity markets look unperturbed by Omicron and resultant restrictions. Frontline indices rallied for a fourth straight day on Wednesday amid a solid rally in financial stocks. The Sensex and the Nifty reclaimed their crucial levels of 60,000 and 17,900 respectively, overlooking COVID-19 restrictions placed by state governments. Is this a cause for concern for investors? Are markets ignoring the threat from the third wave? Let's find out.
After Delhi, Karnataka became the second government to impose a weekend curfew in the state, starting this week amid rising COVID-19 cases. With positivity rate approaching the 10% mark in Delhi and around nearly 3% in Karnataka, the states are eyeing a total curfew over the weekend, including a shutdown of non-essential shops, malls, and more restrictions on public transport, weddings, and funerals. Maharashtra, Uttar Pradesh, West Bengal, Haryana, and Punjab too have imposed similar restrictions. Yet, the sporadic curbs and steep rise in coronavirus cases have failed to deter market bulls from their march. In the first 3 days of calendar year 2022, the BSE Sensex has already surged nearly 2,000 points, while the Nifty 50 has climbed about 600 points. So, are the bulls ignoring a potential threat from a third wave and localized lockdown? Vaibhav Sanghvi, co-CEO of Avendus Capital, decodes this market behavior.
What's happening is basically the markets are looking at a template, of previous lockdowns and some experience from South Africa as well, where we saw that the kind of infection on Omicron kind of spiked up with a very short period of time, but then later on tapered as well. At the same time, what we believe or what we see from the data perspective is that the infection is not as severe as what it was in terms of Delta. So in that respect, market is relatively more comfortable than earlier, even in spite of the rising infection. And two, that, as against the last 3 months of selling by FPIs, what we have seen in the first week of January is some instances of, or in fact, a welcome sign of FPI coming back in terms of net buyers as well. So when you have domestic flow, which is pretty positive, added to it, we have FPI flows, which starts to be positive, is when we think that the markets might, in anticipation of good quarterly numbers as well, might take a positive cue out of that.
Vinod Nair, head of research at Geojit Financial Services, too believes that since the severity of the Omicron variant remains low, the markets expect restrictions to be removed soon.
The experts, what they are saying, if you believe that Omicron is not that big issue, so these restrictions will be removed. And these restrictions are there, as an after effect of what has happened recent time because of the increase in cases. So I don't think Omicron or these restrictions is going to impact us when the Delta, much more issue, did not impact us. And now, we are in a position, the market, the economy knows how to work from home. So we are in a better off situation than what when the unknown issue happened in the 2020s, there was a lot of issue regarding this, but now we all know how to manage this situation. So I don't think this is going to impact us.
That said, mild consolidation cannot be ruled out over the next few weeks as investor focus will shift to key events.
We are now at the upper end of in terms of valuation and in terms of the trend also. So we can expect some consolidation maybe in the later part of this week, next week also. After these FOMC meetings and RBI meetings are there, and then the Q3 results will start. And then we also have to think about what will happen in the budget. So when market will start factoring those things, maybe in the near term, we will see some correction.
In nutshell, expectation of healthy Q3 earnings from India Inc. and resumption of FPI buying are outweighing concerns surrounding new virus variants. Thus, any lockdown, analysts believe, may not be met with serious correction as market participants will eye economic growth and the government's reform agenda. As regards Thursday, weekly F&O expiry and stock-specific action will remain key market triggers.
Most emerging markets, including that of India, are performing so well because they carried out radical economic reforms like privatization and disinvestment in early 1990. The then government, led by P.V. Narasimha Rao, charted a new industrial policy in 1991 to offload stakes in public sector undertakings. Privatization and disinvestment became the new norms then, and they still are. Loss-making national carrier Air India was privatized last year, and the government is going ahead with LIC disinvestment this year. But is there any difference between these two terms? Our next report finds out.
The government sold Air India to the Tata Group for Rs 18,000 crores last year. It got just 15% of the total amount, while the rest went to the debtors. The centre had been trying to offload its entire stake in the airline for years. After the nod of the Cabinet Committee on Economic Affairs, the government is now taking LIC to the primary market to divest some of its stake. The government says that it just wants to go for an IPO and not for privatization. We have also heard our Prime Minister Narendra Modi saying that the government has no business being in business. So, the government's intentions on privatization and disinvestment are very clear. But are these two terms different? Let us start with disinvestment. It means the government or an organization is liquidating or selling its stake in a company, but it will be less than 50%, and the government or the organization will still be in the saddle, calling the shots. Governments often take this step to reduce their fiscal burden and reallocate resources into other productive areas within a government-funded project or an organization. Disinvestment provides funds for growth-oriented programs and development. In 1999, the Indian government set up a separate Department of Disinvestment, which is today known as the Department of Investment and Public Asset Management or DPAM. It operates under the Ministry of Finance. The government announces its targets for disinvestment each year during the Union Budget. For the ongoing fiscal year FY22, the government has set a disinvestment target of Rs 1.75 lakh crores. The plan includes privatization of 2 public sector banks, Shipping Corporation of India, and many other PSUs, besides the public listing of the Life Insurance Corporation of India. However, the centre has so far garnered only a little over Rs 9,300 crores, mostly through minority stake sales in companies such as National Mineral Development Corporation, Housing and Urban Development Corporation, and Indian Petrochemicals Corporation, now Reliance Industries, among others. This sum doesn't include the amount raised through the privatization of Air India, which was the Modi government's first privatization deal in 7 years. Now let us understand privatization. It refers to the sale of the government's majority stake or the whole enterprise to private investors. In case of privatization, the government doesn't hold the resulting control and ownership. While the government is confident of mopping up Rs 1 trillion through LIC's IPO in this fiscal year, the planned privatization of Bharat Petroleum Corporation Limited is likely to spill over to the next financial year. This would mean that the government will miss its disinvestment target yet again.
Apart from its popularity in the 5 poll-bound states, the government's political will to move ahead with reforms will also be tested this year. That's all we have for you today in this edition of the Morning Show. We'll be back tomorrow with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.